The Witan Investment Trust has just produced its annual report for 2021, and to discuss that now, I'm joined by its Chief Executive, Andrew Bell. Well, Andrew, before we move on to the annual report itself, there's extraordinary things are happening in Russia and Ukraine and for the global economy. I want to start by getting your thoughts on that as a long-term investor.
Well, I mean, obviously as human beings, we're all appalled at the nature of the aggression, both in terms of intruding on Ukrainian sovereignty, the suffering which is obviously being visited upon the Ukrainian people, and the apparently either negligent or deliberate way that civilians are being targeted. And as a human story, that is commanding all of our attention at the moment, and it's going to be a while before we can predict what the ramifications or outcomes or consequences are for international relations and for economies. And when you see something like this happening, it does rather set into perspective what we spend all our daytime jobs doing, which is trying to look at what's happening in financial markets. And in the end, financial markets have to be a reflection of what's happening in the real world, which usually behaves itself, but not on this occasion.
Let's come back a little later to some of the forward-looking things that you're doing on the portfolio given this context. But just coming back to the annual results themselves, 2021 was a year again dominated by the response to COVID. How did Witan perform through that?
It was an incredibly variable year, despite the fact that markets went up quite a lot overall, because we had periods of pandemic gloom followed by relief at the rollout of vaccines and their success. We had economic growth accelerating in the middle quarters of the year as countries came out of lockdown, only to be ambushed by shortages of key components because of global supply chain disruptions. And we had fears of deflation at the beginning of the year, giving way to inflation at the end of the year being the highest it's been for decades. So overall, during the year, we produced quite a strong absolute return of 15.8%, though it wasn't enough to keep up with the benchmark's 19.9%. And one of the main causes for that was that the end of the year, such a variable year, coincided with a gloom period when the rapidly spreading Omicron virus led to renewed lockdowns in a number of economies. And our portfolio was positioned for a continuing economic rebound, which obviously went into a brief recession at the end of the year.
So what were some of the main drivers of performance?
The biggest driver was the overall rise in equity indices, which, with the exception of emerging markets and Asia, which were laggards, were up between 15 and 20+%. And that's obviously a tide which helped to float all boats, including our own. In terms of specific contributors, gearing and share buybacks contributed to our relative returns because we were buying our shares at a discount and gearing into rising markets at in the cost of capital so much less than the rise in the markets was a benefit. Overall, our portfolio lagged significantly behind. And one of the reasons for that was that there were only 4 global sectors that outperformed last year, which were technology, oils, financials, and real estate. Now, those are things that are not usually bedfellows in the same portfolio, and candidly, our managers overall didn't have enough of them.
And how did your individual managers perform in 2021? Did you make any changes to the portfolio?
Well, most of our managers had periods of strong performance, but because sentiment was so changeable, actual relative performance was something of a seesaw, and that as at the end of the year, our portfolio had lagged behind the benchmark indices. And clearly, gearing, which was a benefit last year, is meant to be the icing on the top of an investment return cake. And candidly, our cake didn't rise as much as the market last year. We made a few changes during the year, other than minor trimming and adding to individual managers. We closed an Asian mandate in April because we wanted to reduce our exposure to the Asian region because its pandemic response and its rollout of vaccines was lagging behind the dawning recovery elsewhere. We also made, on a couple of occasions, additions to our successful GMO climate change investment, which is a fund which is designed to benefit from the international commitment to mitigate or adapt to the consequences of climate change. And we've been invested in that since 2019. Last year, we broadly doubled our exposure to it.
When I look at the portfolio, you've got a core that's typically about 65% global mandates, 10% UK mandates, and that remaining 25% is in a specialist portfolio. What have you been doing on that in the last 12 months?
The 25% consists of two broad components. The first is that we can invest up to 10 or 15% in specialist listed investment companies in areas of specialism such as real estate, biotechnology, and listed private equity. And that portfolio actually rose by 19% last year. It was one of our strongest portfolios overall. And the other area, which again can be up to 10 or 15%, can invest in specialist managers, whether they're specialist by sector or by geographic remit. For example, emerging markets is an area we've been invested in for a few years, and that's part of that component. But we made a couple of additions to that last year. Although they're small, they're, I think, significant for the future. One was we invested in an unquoted fund which makes early stage investments in young technology companies. It's trying to find the winners of the future, if you like, and rather than simply buying the well-recognized and highly rated companies that are already big parts of the quoted indices. And then in the fourth quarter of the year, we invested in another unquoted fund which specializes in investing in the intellectual property spin-outs from the UK's leading universities. Now, collectively, those two funds came to less than 2% of our assets, but they're in areas which we think are going to offer the hope of better than average economic growth over time, and which are outside the remit of our core managers.
Witan has increased its dividend for the 47th year in a row. How have you funded this, and what's the outlook for dividends for the year ahead?
Well, as we know, 2020 was a very poor year for global dividends, and we took a hit, as did many, but we had used our revenue reserves to continue our long-term program of increasing dividends. And last year, we saw a very significant increase in our portfolio's earnings. So we were able to increase the dividend and also make less use of revenue reserves than we had the previous year. In percentage terms, about 2/3 of the dividend last year was funded by our 2021 revenue and 1/3 from revenue reserves.
Early in March, Witan announced that it had become a signatory to the Net Zero Asset Managers Initiative. What is it? Why have you signed up?
Witan, I believe, is the first investment trust to sign up to the initiative, although other trusts, I'm sure, support its aims. And the commitment that we're making is that by 2050, our operations and our portfolio will have zero net carbon emissions. And this is part of the international campaign, as agreed at COP26 and previous occasions, to reset the global economy in a way that seeks to limit the amount of global warming to 1.5 degrees centigrade above the level that prevailed before the Industrial Revolution. And that's 1.5 was set because 1.5 to 2, according at least to economic models, is something which appears to be the barrier between what is manageable, though problematic, and something which becomes much more chaotic to manage, which if you had a lot more global warming.
The annual report also states that your target is for the listed equity portfolio to consist entirely of sustainable businesses from 2030. What's your definition of a sustainable business, and how are you going to achieve this?
A broad definition is that in order to be sustainable and therefore capable of delivering good investment returns to long-term investors, businesses need to be honestly and competently managed, carrying out activities which have a future and which are beneficial to society, and in full compliance with all the applicable rules and expectations. And that covers a range of topics, everything from diversity to dealings with suppliers and with customers, from pollution to meeting or having a clear path to meeting carbon emissions targets. And our investment processes are designed to try and find out where on the spectrum companies lie and to hold them to account in implementing their plans to come into compliance with being fully sustainable businesses. And of necessity, that doesn't simply mean investing in companies that are already as pure as the driven snow, because benefit can only come from the non-compliant improving. And that's what our investment processes are designed to identify good companies which are on an improving path and make sure that they stick to their targets.
But in summary, this focus that Witan has got on sustainable investing and on hitting net zero targets by 2050, that's not going to be at the expense of financial return, is it?
Well, no, I think it's the two are completely congruent with each other, because businesses which, if you like, don't have a license to operate or fall foul of regulation or political controversy, or indeed whose activities become obsolete because of changes from other businesses competing with them, they're not going to be able to deliver returns. We see no contradiction between the search for good investment returns and doing it in a way that is beneficial for the planet and its people.
Well, I promised we'd come back to Russia and the Ukraine. Has the portfolio got any exposure to those parts of the world?
Effectively, no. Now, at the end of January, we had around 0.5% of our assets exposed through our emerging market portfolio to Russian equities. That was slightly reduced during February, but obviously we've now written those down to zero. And barring a very small Russian holding in one of the funds that we hold, which is less than 1/10 of 1% of our overall portfolio, much less, happily we don't have any exposure.
And finally, as a long-term investor, what are you focused on given this extraordinary uncertainty and this awful news coming out of Ukraine and Russia?
It's very difficult to map out, and therefore not very sensible to try and make predictions about how this conflict will resolve itself, whether it becomes a long-running sore in international relations, whether there's a dramatic improvement, and it's made the economic outcomes for the next year or two at the very least much less predictable. But we still have to operate with all the uncertainties, which are obviously not helped by Putin having drawn attention to Russia's nuclear capability. And we hope that was a sort of an aside rather than anything he thinks seriously about. But actually, there's a story doing the rounds at the moment of a retired Wall Street manager who was a trainee at the time of the Cuban Missile Crisis 60 years ago. And he was meeting his boss for a drink after work, and he sort of came breathlessly into the bar and said, Russia's just threatened that they're going to start nuclear war if we don't stop blockading Cuba. I tried to sell the market, but I wasn't able to. I was too late. And the boss said, son, if there's a threat of nuclear war, you buy the market, because if it happens, the trade won't settle. And if it doesn't happen, you'll do pretty well. Now, that's obviously part of humankind's way of trying to make light of the serious. And I think we have to, we're assuming very much that what we have in Ukraine is a conventional war, which we hope is going to be resolved in a way that reverses the aggression. But in the meantime, it's worth remembering that most political events, even wars, and there are obviously exceptions, but most political events don't tend to have such major effects on economies and on society as they were expected to do at the time. So accepting that the environment in Ukraine is very hard to predict, so we're keeping a very close eye on the short-term risks, the change probabilities around what we think is going to happen in economies over the next year or two. But the most important thing, I think, in trying to manage assets is you have to keep a longer term perspective. And that's what we're trying to do in identifying companies which have got relatively predictable long-term growth stories and are available at acceptable valuations. If we can populate our portfolio with those, then in the absence of being clairvoyant, that's the best job that we can do. And in the end, economic growth and businesses growing the value of their own business is what tends to drive share prices, even though in the short term, sentiment is a much more dominant factor. And clearly at a time like this, our thoughts are very much with the innocent people of Ukraine who are having to suffer through something which we're simply trying to analyze in terms of its effects on our investments, which appears a much less important issue.
Andrew Bell, thank you.
Thank you.